So, I think if you kind of bifurcate the market into those two sort of the bulge bracket investors and then kind of everyone else on a discrete basis, there's a heck of a lot more of everyone else, you know? And so, that creates sort of like that creates sort of in a way a more dynamic market with fewer choke points and cul-de-sacs because there is such a robust investor and buyer community in the middle market. Whereas you've got a couple one-stop shops for capital if you're looking for $1 trillion.
Definitely. So when I've come out of these meetings, I've heard from folks that they're struggling to deploy capital. Today we had Will Sullivan, who is a managing director running our East Coast transaction team on the podcast. Will actually replaced me in that role a couple years ago and is one of the better hires I've made. He's incredibly smart, has a great background, spent time on the buy side, spent some time in diligence, has owned his own business, and has led transaction teams for us for probably 6 years. So has that great combination of experience, having seen virtually every side of a transaction and played almost every role. It's a great proving ground, and our clients certainly benefit from that. He just got back from a conference in Boston where he met with probably 30 private equity buyers. I always emerge from those conferences both energized and dead. After 30 meetings, you're pretty tired, pretty gassed, but you also come away with a lot of enthusiasm, a lot of themes, a lot of messaging, and you figure out kind of what these guys are actually looking for. And that's what we talked about today. There are a number of industries that are still incredibly hot. Industrials remain really, really hot. And then a lot of things related to sort of macro trends that we're seeing in the overall economy. So, data centers, obviously, anything that touches a data center. So think of what needs the heat and cool. So that, we see Carrier as a great proxy for data centers, right, in the market. One way to identify whether data centers are going to continue to expand or contract at some point. Wastewater, all this infrastructure is a really big one as well. We talked about all of that. We talked about sort of how buyers are looking at the world, how they're deploying capital, where they're really struggling. And we talked a little bit about deal structure, some structural components on deals that maybe are a little different this year than last year, and a bit more on where the market's going the rest of this year, and maybe some pointers for someone considering going to market. We'll spend a lot of time over the last 6 years doing deals. He's done probably 200 deals over the last 6 years. So no one's better qualified to illuminate what's going on in the market. I hope you enjoy this episode. Thanks, guys. Cheers. Welcome to Closing Remarks. I'm Dara Shareef, your host, and I have with you today Will Sullivan. Will, introduce yourself to our crew.
Sure. So, Will Sullivan, great to be here with you, Dara. So I'm managing director here at Benchmark International. Basically, I oversee all of our transactions on the East Coast for the firm.
You do. Why don't you give us a bit about your background before you got to Benchmark? I think it'll help really sort of seed the conversation.
Yeah, sure. So, before coming to Benchmark, obviously we're a sell-side firm. I spent about almost a decade on the buy side, so primarily supporting private equity groups, banks, hedge funds, and other types of buyers on transactions in primarily aerospace, defense, and just sort of government-related industries.
And you've become our de facto guru on GovCon. Everything GovCon, people just call Will, even if it's not his deal.
Yeah. Well, so there's a couple industries out there where it's very helpful to have some actual, inside baseball experience. Healthcare is like that. We obviously have, great assets within the firm who deal with healthcare as well. Aerospace, defense, government services is a very similar dynamic. Anything that touches, I think, regulation and the government in a big way, it's really helpful to be able to understand sort of, how the contracting works in those spaces, who the players are. There's a whole separate vernacular sort of associated in both of those industries with just kind of doing business in those industries. And so, so that's right. So, I have become a bit of a go-to resource, I guess, within the firm with regard to sort of anything that touches the government space. And so we obviously do a lot of work in aerospace, defense, government services, and increasingly so. So I'm certainly happy to be helpful in that regard. Yeah. And those are great industries. They're very, no pun intended, but they're defensive industries, right? So there's kind of always robust We have a great counterparty, typically speaking, when you're dealing with the U.S. government. And so there's a lot of interest in that space. It's obviously a huge sector and getting bigger. And so, yeah, we've done a lot of really great work in that space to date. We're looking forward to doing more.
So Will has the, I won't say rare distinction, the distinction of being sort of better than me at almost everything that's important in our business. He replaced me to lead the East Coast transaction operation. He's a little bit younger. I would say a little bit funnier. I would say a lot smarter and has a better voice. I think all those are fair.
I don't know how fair that is. You're much better at being self-deprecating than I am.
There you go.
So, I mean, call it a win.
That is true.
Yeah.
So I have to win somewhere. There we go. Well, good. So you just got back from Deal Max, which in Boston, I believe.
Yeah.
Which is one of the ACG deal sort of functions where you do speed dating with 600 to 700 buyers in about a day and a half. So usually when I've done that, I come away with some really good themes and also what's hot, what's not. So that's why I wanted to bring you on now. So why don't you give me sort of a recap of some of the themes first that came out of it? We'll get into industries after that.
Okay. Yeah, perfect. So yeah, I mean, some of the thematic, I mean, this is going to overlap with industries, sort of necessarily, but I think, some of the big themes that came out of that. And so this is the ACG, the big East Coast Deal Max event up in Boston last week. And yeah, it's speed dating with a lot of buyers, mostly private equity groups, but some corp dev teams, obviously from strategic as well. And it gives you a really good opportunity to just sort of get your pulse and kind of how the buyers view the universe, which is obviously very important. We, have our own kind of perspectives as well, but sort of understanding how the top buyers, in terms of just financial sponsors are looking at the world is always very helpful to us in terms of positioning our clients, properly and just sort of understanding, kind of where some of the thematic fast streams are, right? At any given moment, any given quarter. It wasn't a huge surprise. I mean, we were seeing a lot of sort of echoing of some of the themes that we've been sort of just seeing in the transaction work that we do. One of the big ones, I think, is sort of a continuing theme, a continuing trend of kind of a renaissance and interest in the U.S. industrial base.
Yeah.
And that's a really big, that's sort of a macro theme or a meta theme, really. These are companies that are effectively making things in the United States has become of a real interest. So that's one theme. So I think, light manufacturing to middle manufacturing to sort of, logistics type companies really just kind of across the country. So whenever, there's all sorts of flavors of industrials, right? And so you have, people making everything from kind of rebar and angles and sort of selling that into all sorts of different types of construction projects. To people who are kind of like, you kind of go up and up and up to people who are putting two things together and making some sort of, indispensable widget that, is seeing a lot of scale right now. To, people who are doing sort of complex manufacturing and creating more specialized systems into industries like healthcare and industries like aerospace and defense, et cetera, et cetera. I'm trying to talk about this as broadly as possible because it is so detailed.
It is, yeah.
Auto industry, for example, has an exceedingly long sort of tail in the manufacturing and supply chain. And a lot of those tails will overlap with aerospace, for example. And so as both of those industries are, continuing to grow in sort of a secular way, but also continue to see renewed interest from an investment perspective and tailwinds from sort of a policy perspective, we are seeing, the buyer community, they're never slow to catch up to these trends. And so we're seeing a whole lot of that.
So the entire value chain is being impacted.
The entire value chain is being impacted, and of course our advisory, is primarily focused on the middle market, right? And so the middle market, if you kind of think about like the industries that are fed into by these value chains and these supply chains, it's pretty consolidated at the top, but there's such a long tail that most of the market really is kind of where we are, right? Just in terms of the value chain, in terms of the supply chain, it's very complex. It's very, sort of variegated in terms of the types of services and products that are being fed into it. And so, while we are sort of middle market, lower middle market to middle market, that's really most of what goes on in these industries. And so it's pretty exciting to see the, I wouldn't say renewed, but continued interest and increased interest in investing in these spaces.
In the macro trend, I mean, obviously when you have Liberation Day beginning of last year, and you have basically the death of globalism,
Well, yeah.
And we can debate that. You
An
and I
initial
had,
blow.
yeah,
Yeah.
you and I have had some interesting discussions on China's role
Mhm.
in the world as a manufacturing
Right.
power going forward, but
Right.
related to their demographic issues that they have. But
Right.
probably another podcast that we can
Mhm.
do. We'll do our geopolitical podcast maybe tomorrow.
Right. Okay.
But
Yeah.
some of those trends are obviously forcing onshoring, nearshoring,
Mhm.
and that's the macro trend that's sort of resonate or manifesting in what you're seeing out there.
Right. Yeah, 100%. So, I mean, it's sort of is the Trump administration sort of a one-off with regard to this more sort of protectionist, somewhat
Yeah.
less free market approach? Some might call it protectionism of sort of core industries that that there is a perspective we should be producing a lot of these things here rather than outsourcing it. And obviously, obviously the tariffs, which are constantly in a state of flux, depending on kind of where they are in the court and how they're in the
Yeah.
courts and how they're implemented and what the courts will allow, et cetera, et cetera, et cetera. I think the big question is, where's the signal and where's the noise?
Yeah.
So there's a lot of noise around it, but is the signal toward a more protectionist regime sort of writ large moving forward? And I think you see a lot of support for that, not just on the sort of Trump base sort of Republican side, sort of the MAGA Trump voters, but you see a lot of that as well, even more traditionally on the Democrat side. So,
Absolutely.
to the extent that there's two sort of loci of interest in that same policy in both of our two major political parties, I think buyers are starting to discern a trend. So they're starting to sort of pick out some signal from the noise in that, and they're starting to place bets accordingly.
And we're also seeing a lot of activity around infrastructure.
Correct. Yeah, that's the second of the sort of three big ones that I sort of took away from this. So infrastructure is huge, right? And so there is, the crumbling infrastructure issue has been, I was like 20 years ago the first time I heard Singapore's airport's better than ours.
Right,
Everyone's
right.
are,
Yep.
and
Bridges, right?
Yeah, bridge. Well, I mean, so that's a big thing. So that bridge got hit 2.5 years ago off
Yeah.
of Baltimore.
Yeah.
I said at the time, unfortunately, I don't think this is going to get rebuilt, and they haven't begun. You know what I mean? And so I think I don't want to be right about that, but I think a lot of people are noticing. Shouldn't we be able to do this? Shouldn't we have?
Yeah.
Shouldn't we have started rebuilding this?
A major city in our country, a major port city. Yeah.
And just a major thoroughfare on
Yeah,
like the most
on
densely
95.
populated part of the country.
Yeah.
And so, I think there's an increasing understanding that, despite what the various sort of like push and pull regarding sort of allocation of resources is going to be moving forward, maybe it's not going to happen in 2 or 3 years, but over the next 20 years, are we really going to have to start doing something different from an infrastructure perspective? And so, I think that's a huge theme that sort of came out, which is confirmatory of everything that we've kind of talked about anyway.
Yeah.
But so that's going to be everything. Obviously there's the bridge, right? And that's sort of like the charismatic metafauna of like
Right,
infrastructure, right?
right.
Everyone knows it, everyone sees it. But there's so much beneath that, right? So everything from from electrical
Yeah, the
utilities,
grid. Yeah.
from the people who provide the services
Mhm.
to the people who provide the copper and the fiber. That's an enormous theme. Wastewater management.
Yeah.
So wastewater management, everything touching water,
Mhm.
frankly. Wastewater management is big, but also just sort of clean water delivery, right? So you have cities where, I mean, most of the cities on the East Coast, the majority of the pipes that run under the ground feeding people supposedly potable water
Yeah.
are, 100 years old.
Old. Yeah.
And there's stuff crawling around in there. So, I think that's a big one, right? So how long are they going to hold up? I mean, I know the Romans built stuff that lasted 200 years, 2,000 years,
Yeah.
with regard to that, but ours is probably a little more frail, it seems to be. So I think reinvestment in that is a big one that people are starting to really realize. And I mean, it comes down to everything, even, just like paving companies,
Yeah.
anything that's sort of macro infrastructure in this country is receiving a whole lot of interest right now. And I think there's a lot of buyers out there who see the writing on the wall and are placing bets, or have already begun to, right? And so they have platform plays in these space and they're actively seeking, bolt-ons, sort of as quickly as possible. And so that's great to see. And then the other big sort of draw on water that we're hearing, as well as electricity, as well as every other flavor of utility, is the other main theme, which is just data centers, right? And so data centers pulls on all of these things. So, the water usage, and a lot of these are topics that are effectively being used as counter arguments as why we shouldn't be building data centers. And so
Yeah.
that's kind of the headwind you see in state after state after state, it becoming increasingly apparent that these are going to be politically difficult to stand up. But I think to the extent that you're placing a bet that these are going to be stood up somewhere, and probably increasingly so, there's an understanding that the draw on the power grids are going to be, big. Draw on power is going to be big. Where that power is coming from, we don't know. So whether it's, some combination of an update of the current infrastructure, the existing infrastructure, whether it's, data center, whoever is building the data centers, building their own utilities, whether it's nuclear or some other
That's
source.
what they're doing in Pennsylvania. It's a requirement, new law.
Right.
If you want to bring a data center to Pennsylvania, you've got to bring your own power, bring your own water.
Yeah. And increasingly that's the case. And, I think the data center builders are saying, no problem, we could do that. Give us the regulatory framework to actually do that.
Right.
And it'd also be great to have, funds from the municipalities and the states along the way. So I think a lot of that's going to take a little while to kind of work out just from sort of a, administrative and regulatory and legal framework perspective. But again, it's placing chips early, right? And so, okay, so we're not going to build the data centers because we're not Amazon. Where can we benefit, in terms of just sort of like non-public investment, right? So in other words, not public equities, but, private investment, where are going to be the places that we can actually, place some capital to be successful here and to sort of be a part of that story. And a lot of it really is, it's the obvious things. It's the grid, to the extent that nukes are going to start getting built, like water usage is going to become a big thing. Water usage is going to be a big thing anyway. But there's all sorts of, there's a big long tail to the data center story that people wouldn't necessarily think of. And this is both with regard to, products and services, right? And so, if you look at, and just the things you wouldn't really think of. So these data centers, all of them are going to need to be SCIFed. So secure, compartmentalized information facilities. And what this is basically, it's a government sort of defined regulatory framework in terms of like how you're able to do business with the government around classified information. And so what the SCIFing of a facility means is, it means different things for different levels of clearance, but some of the items include effectively turning rooms into a big Faraday case that nothing can sort of penetrate, all the way down to like the design of the room itself, to, how do you control access, into and out of the room. There's all sorts of sort of, usage regulations. So you have to follow these protocols when using it, et cetera, et cetera, et cetera. And so what we're seeing now, just to give like an odd example that most wouldn't think of, is SCIF builders and designers are seeing a big, boost from this, right? So all of these, for example, construction companies, your usual suspects that you would normally see as sort of the natural builders of these facilities who don't necessarily have like a SCIF capability, they're going to need to get that, right? And so that's one kind of, example that most wouldn't come up with off the top of their heads.
It's a huge opportunity. It's definitely a growth sector, right? So those would be logical buyers for those kinds of companies.
Yeah, 100%, because it's basically a SCIF super cycle that's happening. At the same time that they've updated all the regulations around SCIFing, and obviously they made them tighter, not looser, right? So that's a big one. Everything down to like turbines, right, for cooling, right? And so there's turbine companies that are basically companies stood up by engineers who are able to come in and sort of engineer your based on your your materials use and your energy use, what kind of turbines you're going to need to sort of like move fluid dynamics in and out of the system, how are you going to do your cooling, et cetera, et cetera. And if these data centers over the next 10, 20 years really do populate even 20% of our states, that's going to be an enormous opportunity, and that tail is going to pull along the turbine guys. And there's just dozens and dozens of other opportunities that, again, looking at the middle market, are huge opportunities leveraged to this massive macro trend.
Definitely another trend that we're seeing is sort of the flow of capital, right? So if you think about where private capital, private credit is going, they're saying $6 trillion in the next 4 years are going into data centers, which is an incredible amount of money. That competition for capital really takes away from the capital that can go into building out our manufacturing base. And we need to build out our manufacturing base. We need to build out Nuclear facilities. I know we can build them faster than we used to. The traditional ones take decades.
Yeah.
You can do these in 5 or 6 years.
Smaller designs, yeah.
Smaller designs, but they still take time and they take a lot of capital. And that sort of competition for capital is what we saw in the late 90s with the fiber build.
Yeah.
You know, that's why people are talking about a potential bubble with AI is I think it's the capital. The other part that no one talks about is that $6 trillion in AI CapEx spend. About half of that is NVIDIA chips, which has a 2.5 to 3.5 year useful life. Not really CapEx, more like X, right? More like expenditure. So I'm curious what you're seeing in terms of the flow of capital.
Yeah.
How that impacts the lower middle market and the middle market.
Well, with regard to AI, yeah, I mean, and there's competition for NVIDIA chips now. I mean, so NVIDIA has competition. So there's a lot of sort of disruptive entrants who are trying to find, you know, a way to do what NVIDIA does a little bit better, a little bit more efficiently. Now, these are going to be super large, you know, public companies. You know, the largest of the sort of disruptors just went public like 3 months ago, Cerebras. So, yeah, you're going to see that. How it trickles down. I mean, I would say that, you know, in terms of just like, if you want to look at the competition for capital or just the allocation of capital or the availability of capital, one of the big problems that private equity has had for the course of maybe 3 to 5 years is too much capital, chasing too few opportunities. So, I mean, there is a bit of a contrarian perspective that perhaps, you know, this, you know, sucking sound coming from AI could relieve a certain amount of pressure, you know, from a capital perspective. But, you know, I would just say, to completely contradict the point I just made, there's also there's also a little bit of a, you know, clear distinction and separation between the capital that's chasing, you know, this type of opportunity, these like this $6 trillion, this $6 trillion, it's going to be divided into like 10 tranches or whatever, you know, whatever it ends up being, versus, you know, the type of capital that's chasing opportunities in the middle market and the lower middle market. So
it's segregated. That's Blackstone is not doing, you know, a $12 million deal to buy a manufacturer out of Clearwater.
Right. Yeah.
They'd have to buy 1,000 of those a month.
Right. And and for every Blackstone that's not doing that, there are 1,000 other equity groups that are doing that. And that's exactly where they focus. So, you know, I think if you kind of bifurcate the market into those two, sort of the bulge bracket investors and then kind of everyone else on a discrete basis, there's a heck of a lot more of everyone else, you know? And so, you know, that creates sort of like, sort of in a way, a more dynamic market with fewer choke points and cul-de-sacs, because there is such a robust investor and buyer community in the middle market. Whereas you've got a couple one-stop shops for capital if you're looking for $1 trillion.
Definitely. So when I've come out of these meetings, I've heard from folks that they're struggling to deploy capital. They're struggling to deploy because a lot of B and C assets are not going to market because of the uncertainty. The A assets are trading at crazy premiums, and the folks who have not yet, you know, sort of hit on a deal, who have swung and missed for 18 months and not deployed any capital, they have so much pressure to deploy capital. They're writing checks that they shouldn't. Right, just to get in the game, to demonstrate that they know how to deploy capital. We're even seeing funds return capital to LPs. It's like, what a crazy environment. Did you hear any stories like that?
From a buyer's perspective, on the buy side, yeah. I mean, we know that that's happening. You know, we talk with PE all the time, and they reflect, you know, the exact same dynamic that you just articulated, which is, you know, what they always say, the same thing. We're trying to remain disciplined. You know, which only means that there's a lot of temptation not to be disciplined right now, because you'd certainly rather deploy the capital than give it back to your LPs, because no one's really happy. It's like, well, you've been sitting on this for 3 years or whatever the time frame has been. Thank you for my 0% interest rate during that period of time. You know, versus getting, you know, in trouble down the line where, you know, you've actually deployed the capital, made the investment, and perhaps your returns aren't what you articulated in your prospectus when you initially raised the funds, right? And so, man, I feel bad for those poor guys. You know, America. I wish, you know,
GoFundMe. We'll start a GoFundMe.
Yeah, I wish they weren't facing this horrible problem right now. But yeah, we see that all the time. And I mean, from our perspective, you know, our preference is, hey guys, deploy the capital. What are you doing?
Plenty of deals.
You don't want to give it back. You know? But we do see. I mean, we see discipline. I think that, you know, I think from our process perspective here at Benchmark, obviously the way that you get around that is that not all every opportunity is a unique snowflake. It just really actually is,
It is.
and it's just a matter of finding the buyer for whom that, opportunity is the Rosetta key that unlocks something for them. You know what I mean? And so,
Absolutely.
whereas, yes, they're trying to stay disciplined, from a top line perspective in terms of their portfolio approach. If, a private equity group even has a platform, and we're representing an opportunity that's going to unlock something big, for them. That's at the end of the day, that's our job. Let's find that buyer who really needs you so we can get some stretch on this.
Absolutely. So there are still some funds out there that are COVID vintage funds who have DPIs, which is distributions or dividends to paid in capital, which is sort of the return they've gotten out of what they've deployed so far. It's a pretty key metric for those guys.
Right.
That's under half.
Yeah.
So we're talking 5-year-old funds that should be done deploying, and they're not close to done deploying, and they haven't really created any real returns to their investors. And we're ready to see something monumental, I think, in the next couple of years for these folks.
Right. Yeah. Yeah. I think so. And even though yes, there are funds that look like that. And yes, there's sort of there's a lot of pressure in the system from excess capital right now. But that being said, we work with buyers all the time who are raising new funds.
Definitely.
They figure out a way to get it done, So, again, it's just, not, you got to find those, at the end of the day. Because not all buyers are seeing the same problems. Not all sellers can be painted with the same brush. And so, the macros don't always feed down into the micros. And I think, one of the sort of benefits of the middle market, is that, we're not as subject to the macros as are the macros, as you might expect. Profound statement of the day. You can clip that one.
We will. Kyle, clip that one.
Yeah. And they tend to be just a little bit or a lot more insulated to the headline risk,
Yeah, but these are not bet your company sort of bets, right? If you're $100 million strategic, right, and you're buying a $15 or $20 million business, if you choose poorly, it's not taking the business down. If you buy an $80 million business, it might take both businesses down if you don't integrate correctly, if you overpaid, if there's not a synergy there in some way.
Yeah,
that's definitely something we've seen. So some of these, you're saying some of these macro trends are not translating down in the lower middle market and the middle market. So what are you seeing in terms of activity from buyers in the lower middle market? Are you seeing a lot more private equity funds, seeing more strategics getting involved? You're seeing a lot of family offices start to dip in?
Yeah. So, one thing I'll say is just the lower middle market companies tend to be insulated from the bad news, but able to benefit from, the headline fast streams.
I'd agree. Yeah.
That's just sort of, I guess, a way to put a bumper sticker kind of way to think about it on it. Private equity buying, we are seeing an increase in that. I think the line between private equity buyers and strategic buyers is becoming
very blurred.
Increasingly blurred as private equity ownership sort of scales. So, I would say that, it for a while it had been kind of half and half. We were able to sort of discreetly segregate, like kind of, okay, there's this set of buyers and there's that set of buyers. As it sort of merges together, I think we're seeing a, plus 50% flavor of PE in most of our transactions at this point. And I think that's probably been the case for a couple of years now. So even if it's a, multi-billion-dollar platform, and we've had several exits to multi-billion-dollar platforms in the last year, the chances that there's some PE sort of backing in the mix has really gone up, I would say, in recent years. Yeah. Which is what you would kind of expect, just by looking at the amount of capital flowing into private equity right now.
Yeah. And they're trying to roll up these fragmented markets and they're desperately trying to find proprietary deal flow.
Right.
And we're trying to make sure they never find it because we want to represent those companies that are most interested.
Right.
So going back to a point you made earlier, it occurs to me that maybe the best opportunity for just a couple deal guys chopping it up. No one's listening, I don't think. Don't take this idea; it's a gem. So we should raise a fund to buy sort of secondaries off of private equity funds that are just have great companies, but are struggling to get capital back to their investors, and they can't deploy. So we can create a fund by buying, be a fund of funds and buy, these distressed companies because they overpaid and they can't deploy. I saw this in venture 20 years ago.
Yeah.
And the folks who actually did it, it went very well for them.
Mhm.
But I didn't have at that point. I didn't have the chops to go raise a fund.
Right. Interesting. Okay. I mean, it's a thought.
Investors,
Yeah. I mean,
possibly
it's
you.
sort of, yeah. It's sort of an alternative push release valve to a
Yeah.
continuation vehicle or something along those lines.
Well, but
I mean,
those are getting such negative press, right?
Yeah.
I mean, continuation vehicles have gotten absolutely hammered because they started with just like sort of taking your dogs, taking the worst of your portfolio, putting them in a separate fund,
Mhm.
duping the new investors and say, here you go, you want access to our portfolio, and sort of spinning them off. And
Yeah.
it sort of creates in my view, they create like a lack of alignment between your LP base and your GP, because it's like,
Right.
where are you focusing your time on, like these other ones that you're trying to keep going,
Right.
or in deploying capital in the
Right.
new investments, which is your mandate as a private equity fund.
Mhm. Okay. So you want to create that alignment by taking all the dogs and going in eyes wide open?
There you go. Exactly.
Okay.
Well, I'm not talking
Send
about
me
the dogs though.
Send me
Actually,
the PowerPoint on this.
I'm talking about the guys
Some thought.
who've spent like 12x on an eight times deal.
Yeah.
Right. And they
Yeah.
need to return capital because their
Yeah.
DPI is 0.4.
Mhm.
And they need to return, even if they just sort of get their money back on that one.
Mhm.
And you're just buying low. You're just buying a value play. That's a really good company, but they
Right.
need to get liquidity because they've purchased it at the wrong price.
Yeah. Yeah. I mean, it's true. They need. I mean, they need some options for how to exit some of these investments.
Yep. It's on you. This
I'm
is
not
our
sure I'm
plan.
going in on you with this.
No. Listen, I got a deck,
Okay.
Claude.
Yeah.
I'm having Claude make one right now as
Okay.
we speak on my phone. I'm very clever here.
Okay.
So anything else come out of that, that sort of, that conference? Usually I come at it with just like I'm tired because I've had 37 meetings in a day and a half.
Yeah.
And I've got like an incredible amount of energy because you're around really smart people. And any insights, emerging coming out of that conference that you're going to, report back to your team and say, here's what we need to focus on. Here's what these guys are looking for. Obviously,
Yeah.
we talked about sectors, but
Mhm.
any other themes that emerged from that conference that you'd want to maybe convey to an audience of business owners and their spouses?
Yeah. I guess the another big theme was that Scotland has the best soccer fans in the world.
Well,
So
we know that. Okay, you were in Boston.
Yeah,
That's
we were
right.
in Boston for their first game of the World Cup, which was pretty amazing. Didn't go to the game, but
No.
everyone was Scottish in Boston.
I
weekend,
believe that.
That was interesting. I wouldn't have guessed that. Other big themes. I mean, those are, I guess from a market perspective or just sort of a sector's perspective, those were the big ones.
Any talk about sort of like cost of capital changes toward the end of this year, what the Fed might do with the new Fed chair?
Mhm.
And these guys must be thinking about like, okay, so the cost of debt obviously figures into a transaction
Yeah.
because, weighted average cost of capital is
Mhm.
how they do their modeling, and whatever they're paying for debt.
Yeah, I don't think
factors
anyone
in.
really has a perspective. I mean, you have a brand new Fed chair.
Yeah.
People are kind of unsure what Warsh is going to be, like where his mandate is coming
Yeah.
from. He's a Trump guy. We know what Trump's perspective is on interest rates. Back to ZERP, I think, is what he would love.
Yeah.
They were held at the most recent committee meeting, which I think was last week. I think it's kind of wait and see on the cost of capital. A lot of pressure's already kind of been relieved from the cost of capital just over the course of the past year. So
Yeah.
I think that's just sort of, allows some kind of, a little bit of re-underwriting of the way you go to market as a buyer. Certainly, private equity buyer who's going to gear up your deals a little bit. But I think that's already kind of been written in. So there wasn't as much discussion around that. I wouldn't say on this one. I think there's a lot of enthusiasm right now among buyers. So, I mean, obviously in previous years, there's been, it struck me that, private equity groups are now kind of aligning around macro themes that are getting them excited for the first time in a couple of years.
Okay.
And I want to overstate that. That's
Yeah.
obviously not true in all cases, but, I would say that, in prior years, it's sort of been a little bit scattershot. So from the perspectives we have, so I'm group X, I've got platform Y. So I'm looking for stuff for that, but not really sort of, I don't really, not as much of sort of a consolidated thesis around sort of the big macro themes. that we kind of talked about
Yeah.
earlier. You weren't seeing as much of that. So it was kind of like it was chasing HVAC for a while, or it was
Yeah.
chasing
Right.
things that were kind of consolidating. Let's get in on it. And so I think the emerging I think the divergence between, this year and just sort of generally our interactions with, with buyers is that there really are kind of emerging macro themes to latch onto,
Okay.
and be forward looking about
Yeah.
and be active instead of reactive about. I think that was one of the big kind of takeaways for sure.
That's interesting. So that goes back to sort of one of the questions I used to always ask. And I used to say, are you thematic or opportunistic?
Right.
And thematic is, just for the audience, I mean, you have a thesis, like you're going to go attack HVAC, right? You've got an operator, maybe, someone who sold a business in that market. You've really done a lot of work. You've done the white paper. You've got the resources. You know that market. You're going to attack that vertical.
Mhm.
And an opportunistic person was more looking for, hey, I like this cash flow profile. I like,
Yeah.
hey, CapEx lights and not a lot of assets in the business, those kinds of things.
Mhm.
And we have a view on it, but we'll take what comes and buy it at a good price and add some value
Mhm.
at the board level, the
Mhm.
governance, add some, jet fuel in terms of capital
Mhm.
and do some M&A work. And maybe, we've got a great Rolodex, and that's how we grow. It sounds like to me what you're hearing more is a shift from more thematic to more opportunistic, but based upon more macro trends and not, or macro themes,
Yeah.
not themes related to specific verticals.
Um, yeah, I mean, it's probably semantic, but the line between thematic and opportunistic, I mean, there are thematically driven opportunities.
Mhm.
How about that?
Definitely.
So, whereas, I mean, if you've got, for example, if you're looking at ways to deploy capital and you think you can get in at the beginning of sort of, let's go back to the well on HVAC 5 years ago.
Yeah.
That's to me, that's opportunistic. HVAC consolidation, that's a mini theme, not a major theme. I think the macro themes are driving now, which I think is exciting because it creates a lot more opportunities, right? And so if you've got these sort of, I mean, think about what the macro themes were, for the previous 5 years. It was, you know, COVID and
Yeah.
everything that sort of flowed from that, which
Low
is
cost of capital.
cost of capital,
Yeah.
right? Interest rates, and then it was what are the tariffs going to do?
Mhm.
And I think you're kind of free, and that created like a lot of fence sitting at the end of the day, right? And it also, on a discrete basis, if you had someone who was highly leveraged to China for a couple of years, you just didn't want to be there, right? And so I think as some of that has sort of fallen away or been taken away, and these big themes have emerged, they're kind of like positive themes versus negative themes. So negative themes are going to make you more risk averse, right?
Yeah.
And sort of, reduce loss rather than, so think about potential losses versus potential profits. And now I think you've got some major macro themes that are creating opportunities to think more about like, okay, well, like what's our profit profile going to look like over the next 5, 10, 15 years? And I just think it's I think it's a bit of a vibe shift, in terms of just how the market's being approached. There's a lot more optimism and enthusiasm about the opportunities that are out there versus, what's going to go wrong if I deploy my capital in X, Y, Z way, which is, I think, what we were seeing a lot of before.
Interesting. Okay. So the last thing I want to sort of touch on with you, because you see as many deals as anybody probably in the country. So what are you seeing from a deal structural component? So that
Mhm.
perspective that might be maybe a little unique to this year, or something we saw, for about 18 months, we saw everything be an F reorg.
Yeah.
We saw more
Yeah.
F reorgs in an 18-month period than
Mhm.
I'd seen in the prior 10.
Yeah.
So I'm wondering, if there's anything. I started to see a lot of like seller notes being discussed, or earnouts being sort of masked as a seller note, but it's contingent.
Linked.
Yeah.
Yeah.
Well, it's almost like they're calling it a note, but it's an earnout,
Yeah.
right? So
We're
they're
seeing a
making
lot
it
of that. Yeah.
contingent, and there's no interest rate. That's an
Yeah.
earnout. You can call it whatever you want.
Yeah.
What any other themes you're seeing, or
Mhm.
or sort of structural components you're seeing more than you normally would see? Or
Um,
shifts there?
yeah. So I mean, yeah, the seller note thing is real. Yeah, we are seeing earnouts linked to seller notes, however you want to say it. Sometimes the seller notes do bear an interest rate,
Mhm.
However, they're still, basically subject. I mean,
Yeah.
so it's basically an earnout structured as a debt instrument. Um, that hasn't been particularly unwelcome for the most part, I would say. Like if you're going to have an earnout, this isn't necessarily now is total enterprise value. It has to be preserved, obviously.
Right.
Uh, can't have it both ways. But I would say another kind of interesting feature that we're seeing is an increased willingness by platform backers, platform sponsors to allow for investment in the parent company versus just a roll into the sort of purchased asset.
Oh, that's interesting.
Yeah, and it seems to be a way for seems to be what we talk about sort of the need to deploy capital when you find a strong asset.
Hmm.
You really want to be able to stretch to get there, right? But you can't necessarily do it on the debt side because interest rates still aren't
Yeah.
zero, and because for all sorts of structural reasons, this seems to be one sort of give and one sort of carrot, like investing in the parent co rather than just rolled equity. And so that's kind of been an interesting one. We haven't seen a lot of that recently. We've seen that on several occasions more recently.
Interesting.
Yeah, and I hadn't seen that once, really, honestly, for 5 years prior.
So, what do you think for the next sort of 6 months? Right, we're sort of almost halfway through the year. How
Hmm.
do you think the rest of the year is going to play out? Sort of lower middle market, middle market.
Hmm. Yeah, I mean, I think obviously, we're having a great year. I think it's reflective of the market, also our own special
Yeah,
capabilities.
special
But
special talent.
yeah, I mean, I'm pretty optimistic for the remainder of the year. It's been a great year so far. I think for middle market M&A. We're obviously having a great year this year. I still think the same trends. I mean, at the end of the day, what we've talked about, we're kind of at the beginning of all of this, and we're seeing buyers looking to position now for all of these macros and more. We didn't talk about everything, right? But like I said, there's this sort of like profit seeking rather than loss reducing mentality sort of emerging in the market. We're right at the beginning of it. You know, uh, Out of any kind of shock that I'm not expecting, this would be something that I would continue to build, expect to continue to build, rather
Yeah,
than abate. Because again, we are right at the beginning of it, and these theses that are forming around the things we talked about are, they're macro theses, they're long term looking.
they are.
I think it's interesting because everything, it's going to sound corny, but everything we've talked about is just sort of, it's kind of investing in America's future in a very
Yeah,
real and tangible way. And
yeah.
so this isn't like, let's invest in America for the next 6 months and then figure out what's next. I think these are, this sort of a collection of trends that really have a lot of legs. And again, I think it's not one political party or another that
Yeah.
cares about these things. It's both.
Yeah.
It might be expressed in different ways,
Right,
but I
right,
think there are
right.
constituencies, across political spectrum that really does support this for any number of reasons. At the end of the day, it has to happen, right? I think that's like the real forcing function. It kind of has to happen, right? Everything we're talking about. I mean, people would quibble the data centers don't, but
Yeah,
everything else does,
right.
and the data centers are going to. So, yeah. So I think the next 6 months, yeah, optimistic, for well beyond that as well.
Well, the retrenchment of globalism, at least in some way, maybe we can disagree on how
Hmm.
much, sort of is the macro of macros here, right? I mean, like the focus on America
Hmm.
uh, across the board. I
Hmm.
would agree, both parties, and it's not new. I mean, JFK was very much a domestic guy versus international guy, so that's not new. All right, so last question I'm going to ask you today. So, what's the one piece of guidance that you'd give to a business owner considering going to market?
Yeah. So I'd say, you know, the biggest piece of advice is just to be really prepared for the process. Um, you know, Selling a company is, it's a serious step, right? And so be prepared from a couple perspectives, mentally and emotionally,
Yeah,
like making sure this is the right time to sell, I think is really critical. Sort of understanding that, you've come to this point in your life where, you built something great, and for whatever reason you're willing to pass it on to a new set of hands, to take it to that next level.
yeah,
I think that's really important. There is an emotional element to it. That I think not everyone's fully aware of until they kind of get in a process.
no doubt.
And then on that point, be prepared for process. It is very involved. So selling a company requires, a lot more sort of effort, and support in that effort than you might anticipate. This comes everything from sort of, getting all of your financials straight, kind of understanding what it's likely to mean for you, from a waterfall perspective. So, I mean, obviously, someone's buying your company, you're going to have kind of a windfall. Get your advisors on board early to kind of help work through, you know, um, downstream of the transaction, what's that going to mean in terms of tax planning,
Yeah.
in terms of, setting up a legacy for your family, and then kind of upstream of that, when you're going to have, a certain amount, you're going to have a big liquidity event. Get some, if you don't already have some, get some advisors on board that can help you think about how to take that money and not just spend it down, but to grow it and, preserve it, for your family, for your legacy. Those are important things. And attorneys, right? I mean, this sounds like this is kind of banal, ticky-tack sounding stuff, but it's really important to have good legal,
Absolutely.
representation on these as well, and just be ready for a process. I mean, we're geared to find sort of, the best and highest, for our clients, and it does take some time to do that. It takes a lot of process. I mean, we're here working on it every day, but our clients need to be working with us in that process, and so sort of understanding that we're kind of partners in this, and it does take a little bit of time, a little bit of effort. It's well worth the outcome, but really preparing yourself, I would almost say, like, emotionally and administratively for the task ahead is really important. And so, and obviously we try to have these conversations, with our clients, upfront and pretty early, and I think we do a pretty good job of preparing everyone for this reality. But I would say those are the two big things. Like, you really have to kind of situate and prepare yourself for going in.
Definitely. And it has to be collaborative. Like,
Right.
you're not outsourcing this completely to Benchmark.
Right.
You have to be involved. A lot of this information lives in your head,
Mhm.
in your employees' brains.
Institutional knowledge
It has to come out.
important.
It has to be documented somewhere, and we're the ones who are going to sell it to the market. So this is really helpful, Will. I appreciate you coming on.
Yeah, I appreciate it.
And we'll, of course, do it again at some point. But
Of course.
let you get back to earning some money, because some of us in this room are at profit center still, and other
Right.
of us are no longer earning income for the business, and we just suck off of it like a leech.
Thank you for giving me your
Recognizing that?
profit center.
Well, I appreciate it.
Yep.
And remember, in business and in life, the best outcomes aren't found. They're built.